A lot has happened in the first 30 days of 2026.
Venezuela, a projection of American power that made everybody take a breath and think, wow, who could be next?
How can the world be apparently in turmoil and yet we've seen record highs almost on a daily basis?
And why is that, guy? What's going on here? What puzzles me is why that isn't worrying people more.
Welcome everybody to another edition of What's Brewing with Matt and Guy. The last time we met, things seemed to be ending the year on a fairly calm note. But Matt, a lot has happened in the first 30 days of 2026. Tell me, what's your take on all of it?
Well, as we pause to take a breath after the excitements of Donald's Davos,
yes.
I mean, so much has happened in January. It's difficult to, I mean, we'd be here all day if I try and unpack it all for this little podcast. We've had the Donroe Doctrine, realignment of alliances in the North Atlantic as a Greenland friction has played into NATO alliance. We've had more noise in terms of US domestic politics and migration policy. I mean, where to stop, right?
Well,
it's been a busy year.
What about the little incident that we had in Venezuela? And then there was this issue around a large piece of ice, I think the president referred to it, in Greenland.
Iceland, yeah.
Oh,
yeah.
Iceland.
Yeah.
No, Greenland.
Yeah. That's the one. Yeah, look, extraordinary. I mean, Venezuela, a projection of American power that made everybody, take a breath and think, wow, who could be next? Something that the president was obviously very pleased with. Unclear what that means for the rest of Latin America and Western Hemisphere. Is this a pattern that's going to be repeated? Will we see interventions in Cuba or potentially Colombia or Mexico where there are problems with drug cartels and that's been in the sights of the White House already?
You used the word interventions there. I mean, what we're seeing is interventions. We're not looking for, it seems, wholehearted regime change as previous administrations have done. Is that how you interpret this?
Well, I mean, it seems to be what's happened. It was a decapitation, not an attempt at regime change.
Yeah.
And very quickly, the spin from the administration was that this is going to be good for the US because it's reappropriating oil assets and there'll be opportunities for US oil companies to drill, drill, but in the Southern Caribbean rather than in the mainland of the US.
Indeed.
But look, I mean, these are all big political excitements. I think they've left leaders, certainly across the European continent, sort of struggling to get a grip on what's happening around them. They've kept commentators and newspapers very busy. But when I look at the markets, when I look at the sort of economic side of the picture, everything seems calm. It looks like a different world. And why is that, Guy? What's going on here? Are we obsessed by politics and actually we should just ignore it? Or are the markets missing some important structural shifts here?
I mean, unlike you who has to spend all the time with that volatility, of course, I can put my feet up and read the paper with financial markets. Clearly, the lack of volatility has been perhaps somewhat surprising. I guess the most often asked question to me is, how can the world be apparently in turmoil and yet we've seen record highs almost on a daily basis in the financial markets? And I think there's a couple of things that come to mind here. One is that I think investors have realized, certainly over the last 12 months with the current US administration, don't have a knee-jerk reaction to anything that's said, because often it's walked back or diluted.
So investors think they can read President Trump. They think they've worked out how he ticks and they can guess where he's going to end up.
I think that's broadly true. I mean, the style of negotiating, going really hard and then back off, is something that I think we have become accustomed to. And I think that's very different to when we think back to Liberation Day, where most people, including myself, felt, where are we here? This is a completely new regime. We were seeing economic policy deployed in a way that hadn't been seen for about 100 years. And, was there a fundamental belief behind all of that? And I think since Liberation Day last year, we've seen the tariffs change, we've seen policy change quite remarkably. And, we were mentioning Davos. I mean, running into that, we had the threat of additional tariffs placed on 8 European countries if they weren't going to support the desires to acquire Greenland. But the market thought seems unlikely. It will change, and indeed it did change. And that's, I think, why we've seen less volatility, no volatility, but less volatility than we've seen in the past. Now, you can also read that two ways. Sometimes you need a bit of volatility to corral the policymakers, to let them understand they need financial financial markets. They need bond markets to be performing well, to keeping interest rates low. So that's something that we have to keep an eye on for the remainder of this year. But the other key factor, I think, has been the myopic nature of investors. They tend to look at what's happening in front of them because they don't really know what's happening further out. And right now, the focus has been on earnings, and the earnings season looks like it's going to be a pretty good one.
And the problem you have if you are a minister, you're a head of government, is you need to look beyond that next quarter. You've got to take a longer term view. Even if it's only to the end of your electoral cycle, you need to think about what the reaction is going to be from your voting public to the pressure that you're coming under. And I think this is where perhaps we will see a bit of a reconnect between political volatility and ultimately some of that volatility feeding into markets, is that the sort of populist pressures, the protectionist, nationalist political pressures that we've seen build over a few years now are not being helped by this sort of brinkmanship in terms of international relations led by the US. I mean, ultimately there will be responses. I think we saw that a little bit in terms of the Europeans' room for manoeuvre in terms of responding on Greenland. Rationally, you might think, okay, we know that there's a good chance this is just bluff from President Trump. We don't want to respond aggressively with tariffs because that escalation will hurt our populations, our economies as much as it hurts the US. So we just play it cool and wait for the storm to pass. But that's very difficult to do if you've got newspapers, news programs saying you're looking weak, you need to stand up and, follow Mark Carney's lead in sort of telling the US to back down. And I just wonder how far we can maintain the sort of rational and calm approach in the light of continued brinkmanship on the other side of the table.
Look, I mean, you're absolutely right. I mean, ultimately, policies matter. But as you say, they're often longer term in terms of the impact that they have. And right now, I think the financial markets are saying we really don't know what's going to happen further out. Yes, there's many issues around that. Yes, there's a lot of things happening that I think are detrimental to global growth, to global profitability. But trying to factor when that has a real impact is beyond, I think, investors' time horizons.
Crystal ball, isn't it?
Yeah, and it's out there. People know it's out there, but also, we have an election year in the US. Is that going to change that dynamic in terms of policy? Will it be scaled back? Will we have actually a period of calm? And there's another element, I think, to all of this is that it is an election year. History would tell us that the midterm elections, in terms of the 4 years of a presidency, from a financial market perspective, are the most volatile. Since the 1950s, I think the average kind of drawdown within that midterm election year is probably around 15%. So when you look at history, you would say this is going to be a challenge for markets, maybe as you were implying that investors need to factor more of these risks in. But a question I have, maybe back to you, is this going to be different? Is it going to be a president who is so focused on these elections, who's so, I think, sensitive to the financial markets compared to maybe some of his predecessors, that he doesn't let that happen? Anytime the market begins to wobble, he'll say something or the narrative will shift in order to prevent investors suffering that kind of drawdown. What's your take on that?
Look, I think only time will tell. I mean, I think you can argue the case both ways, right? I mean, you could certainly say that this is an administration in the US that is very clear on what it wants to achieve, is very clear on the domestic policy agenda it thinks will resonate with voters across the US, and is very clear that keeping, markets bubbling and driving economic growth is front and center. And if you listen to President Trump's speech in Davos, he is very happy to point to all the things he's done in the first year of this second administration that have delivered that. He will claim credit for it, and that narrative will continue through 2026. And I guess the question is, does that land with voters across the US? Do we see a shift in control of Congress? At the moment, that looks likely, but there's a lot of time to go between now and the midterms. And what follows after that is this a president who still has room for maneuver, can still deliver things through Congress, or is he going to be tied up in a lot more sort of politics as usual infighting? I just don't know at this point in time, and I think you can make a case either side. I guess the question is, would any of that really impact what we see in markets, the big sort of structural drivers for trend growth, for continued GDP growth, whether it's US, whether it's in Asian markets, or even in Europe, where the spigot is going to be turned on by the German government. We should start to see that sort of fiscal put have some positive impact in Europe, I assume. I mean, tell me if I'm wrong.
Well, I think markets don't like uncertainty. And that's something that they've had to adjust to. As I said, recently they've come to, I guess, the conclusion that certainly the current US administration, you have to look through it. But when I mentioned the volatility in midterm election years, the reason often they do much better after the election outcome. And remember, of course, as you know better than I do, usually the incumbent party, lose during these midterms. But that's seen as a positive for markets, because markets then say, well, actually, there's not going to be anything radical happening.
We've seen this before. We know what happens.
And I think that's a little bit where we stand today as well. Looking at the popularity, the approval ratings, I think there is a sense in financial markets actually after November. There's going to be a calmness potentially, if that can be possibly said, about President Trump. But he'll be much more constrained in terms of what he can do.
He hasn't been constrained so far by Congress. I mean, the last year was marked by very limited legislative agenda. Yeah. He's avoiding Congress. Yes. He's using executive power to drive an agenda forward at the international and domestic level.
And that may well continue.
I'm sure it will. Yeah. And what puzzles me is why that isn't worrying people more. Not because it's, there's a sort of particular view on what should or shouldn't happen, but just predictability in and of itself is something that markets usually like. And I find it very difficult to work out what's going to come next in terms of foreign policy and how that may impact on the reaction and actions of other regions around the world.
And look, I think it comes back to what we were speaking about a little earlier. Right now, the markets, investors are looking at the global growth environment is a good one. We've got trend-like global growth. If anything, it's been looking a little bit better recently. We've still got interest rates coming down in many parts of the world. We're expecting a lot of rate cuts, for example, in Latin America, coming from Brazil.
Yep.
We think the tech cycle has got a lot further to run, and that's showing up in terms of earnings. So as an investor, you say, look, what do I care about my investments? I care about these companies. I care about their business models. I care about their profitability. And so far, all of that is holding together, pretty well.
What confidence do you have that it's going to hold together in the face of potential political road bumps? So you mentioned Brazil. We've got a key election, presidential election in Brazil later in the year. At the moment, that looks like it'll be positive for Lula as the incumbent. But we've also got
Colombia
and Colombia coming up first half of the year, and both of those potentially under the shadow of this new idea of a Don Road doctrine.
Yes.
I mean, are we going to see more interference from the Oval Office into these elections? What might that mean for their outcomes?
Yeah.
I mean, if I look at it through a political lens, that's something that would, I have a question there. I don't know the answer. But presumably that will also worry investors. Markets will be looking for signals there and want to understand, are assumptions going to be blown off course by political activity?
I'm not sure, because you think about what happened even in Argentina last year. There was clearly incentives put in place to the electorate to keep sort of melee.
It was a monetary intervention, not a military intervention.
Yeah. So I think it comes back to markets just care about really stability and nothing that is really going to create cracks in the kind of the operability of a lot of these companies who have exposures there. So I'm not sure that's going to have such a big issue. When I look to the remainder of this year, what I'm probably more concerned about is frankly less on the political side and more simply on what happens to this AI situation that I'm still very bullish on.
So yeah, you're a buyer of AI driving a productivity boom, and this is a boom, not a bubble from your perspective.
It is, yeah.
But look, I mean, turn your head around, have a look at this from a misery risk perspective.
Yeah.
What are the constraints that could start to tell that would turn that from a sort of boom story into a slowdown or even a bust?
Well, maybe it's worth saying, why do I think it's a boom rather than a bubble? And it centers on the fact that, yes, we've had a lot of spending. We've had a lot of focus on AI. And remember, it goes beyond AI. This is about a technological, I think, revolution that's taking place. And what we've seen really since the summer period is, irrational behavior from investors. You usually speak about irrational exuberance when it comes to bubbles. But since the summer, we've seen investors become increasingly discerning in terms of what they're buying. They're differentiating between the companies that are spending the money and those who are benefiting from that money. They're differentiating between those who use debt to finance their spending and those who use very strong cash flows.
So we're starting to see a shakeout in the AI market. There will be winners and losers, and the winners will continue to drive growth.
Well, and I think that's completely healthy. I mean, that's a sign that actually this is not being priced, indefinite growth or margin expansion. So that's a positive.
Yeah.
Now, the negative of all of this is that we know technology by its very nature is disruptive. And we saw last year with DeepSeek, a new technology coming out, a new use of technology from perhaps China that can distort that. Suddenly something that you thought was the only direction of travel becomes obsolete very quickly. And that capital that was put into that becomes worthless. So that is the nature of technology. And while that should be expected, of course, you could get big disruptors. If there really is a true breakthrough technology coming, as an example from China, that will have a big implication in terms of US tech companies.
An interesting question in terms of the US tech boom is being driven by an awful lot of venture capital. I mean, there's risk capital coming from private sector in huge piles, as well as some sovereign wealth funds. But it's very transparent. It's very clear. On the Chinese side, where's the money coming from? I mean, is this ultimately state-backed financial institutions that are channeling it? And does that mean that there's a sort of state-level risk if there's some sort of bust there? That if the Chinese approach to more open language model sort of application ahead of the one big general AI, if they have got the wrong bet there, does that pose a real risk to China?
So I think China is clearly making a big bet on IT. I mean, maybe one step back, you and I have discussed this in the past. I mean, there's clearly an arms race between China and the US in terms of technology. They want to break through. They want to be able to separate from one another. We know in terms of the trade truce, it's because of that kind of symbiotic relationship and dependencies they have. So China has been absolutely focusing and concentrating on finding breakthroughs, technologies to make them self-sufficient and independent. She has made it very clear that's what the goal is.
And that's the key point, isn't it? Is that this is not just an economic story. This is not just about driving productivity in existing businesses. This is about sovereignty and your ability to resist hard power from the other big powers in the globe.
Yeah. But you know what worries me? I mean, that's the big headline grabbers, right? But my concern with China is, while I think they've done incredibly well in terms of the development, how they're changing the nature of their tech sector, what worries me is they haven't addressed the domestic economy, which matters. We still have a housing implosion there. We still have house prices falling. We have anemic domestic
still
growth.
have 1 billion Chinese who've never been on a plane.
Exactly. And on the other hand, we've had, in the last few weeks, we've seen the surplus in China, the trade surplus at $1.2 trillion. Wasn't tariffs meant to kind of constrain that? So what we're seeing is that China is still focusing on an export-driven model, and they're still focusing on the tech side. And the trouble is, if any of these legs really come under threat, the domestic economy isn't in a strong enough position, I think, to offset all of that. So that is a risk I would have on my kind of radar.
So you've got Chinese fragility. In terms of the sort of US AI-driven boom, I mean, one question for you, how important is that to the overall US GDP story? And two, back to what are the roadblocks that we need to watch out for? What could slow that growth that's not immediately obvious, that isn't part of the sort of investment cycle and deployment, that are exogenous factors that might slow it down? And I'm thinking about some of the political checks that might come if you're thinking about dependency on grid upgrades, energy availability, competition for energy and other resources with local communities who may not be entirely happy paying more for their electricity or having more expensive water because there's another data center down the road.
Well, it's interesting because that has come back into focus again. President Trump himself has mentioned that a lot of these tech companies need to think about having their own electricity supplies, and they shouldn't be forcing up the price of electricity. Now, he would say that because, one, the cost of living clearly is very much in focus right now in this election year. And secondly, prices of electricity in the United States have increased significantly. So we are seeing an impact of these large tech companies And frankly, not just AI, but the electrification in many parts of the world, electricity prices have been rising. And that is a component, or will be a component ultimately, of cost of living and inflation.
Yeah, exactly. There has to be inflationary at the end of the day.
And that's why when you ask me about the kind of risk for markets right now, while the attention is on the overspend in tech or data centers, my worry is actually much more, I guess, boring, if you like, which is the old I word. It's inflation. Because we have got, as we implied earlier, a US economy that's doing pretty well in terms of the growth dynamic. And I think it will do well this year for the reasons that we've spoken about, rates being attractive, lots of liquidity available, the big, beautiful bill. We haven't mentioned that today, but that's going to provide significant fiscal support in the first half of this year. So if you've got an economy that's actually doing pretty well, and you've got inflation already significantly above the Fed's target, it's tracking around about 2.7, 2.8%, not 2%. We've got a new Fed chair coming in that the president has said will be somebody who has a mindset like his of lower, not higher interest rates. Well, then I think there is a danger that actually inflation begins to bubble back up again. And it's not in focus now, but if it were in focus, I think that could disrupt the markets.
Yeah, and I think this is, you're absolutely right to point to inflation as perhaps, not front and center, but absolutely fundamental from a structural perspective. And we've seen the consequences of post-pandemic inflation on, politics across democratic developed markets. It's been very significant. You don't need that bigger increase in prices for average voters to feel pain and to ask for change and look for political solutions. And I think this is something we need to keep an eye on in 26 as well. I think there will be great temptation for governments to be intervening more than perhaps they have in the past in markets, whether that's framed as industrial policy, supporting sovereignty, driving investment in security. None of that is going to come without a political steer as to who, what, and where. By European, by US.
And that concerns me, not just kind of the direction, which one can live with. What I'm more concerned about, and we're seeing this increasingly, frankly, in the United States, is state intervention in terms of policy, in terms of companies, in terms of what credit card companies can charge in terms of rates, what private equity or private companies can invest in terms of the housing market, what Fannie and Freddie should be doing in terms of mortgage rates. That concerns me for the world's deepest, most efficient, financial market, which is the United States. And of course, once the US starts doing it, there is a risk that others start playing at this as well.
So I think you've convinced me happily that there are routes where politics starts to really matter again from an economics perspective, even if the two look a little bit disconnected at the start of this year. It may not endure.
But I have one maybe last question for you, which for me is an interesting one, is, we mentioned the Trump speech at Davos. We haven't explicitly gone into the Carney speech. You alluded to it. But that has been taken very positively in many other parts of the world. We know that he got a rousing standing ovation at the end. How much weight do you put in that? This notion about the middle nations getting together, realizing that they have to look after themselves because the mighty US and China probably are going to be looking after themselves and not everybody else. Was that a profound speech in your view, or was it just something that actually at the time resonated in contrast to President Trump's?
I think it was a very well-framed speech that caught the mood of the moment and said what a lot of other leaders in the room wished they were able to articulate. But I mean, whether or not that translates into some meaningful coordination between these so-called middle powers anytime soon, I think is a very open question. It's not something I see happening quickly, if it happens at all. Well, maybe I do know off the back of Davos. I mean, what we've seen is this sort of flow of those second powers to Beijing to make sure they're hedging their economic exposures to the US a little more effectively. And the more that happens, the more it'll be difficult for that sort of balancing the US response to closer China ties is going to push those middle powers closer together, I think.
Well, let's pause there, and we'll come back to that one in the next session, because I think clearly, given what happens in the first month of the year, there's going to be so much to talk about going forward. So we'll come back to a lot of these issues, hopefully in future episodes. To all our viewers and listeners, once again, thank you for joining us. Remember, please do like and subscribe, and we will be back with you very soon.